Skilled MBA Case Study Series in Accounting. Silicon Valley Bank's collapse in March 2023 highlights the fragility of financial institutions when confidence erodes. The rapid downfall was marked by asset-liability mismatches and poor interest rate risk management. Unrealized losses and fair value accounting played critical roles, while leadership, regulators, and venture capitalists faced scrutiny for their accountability in this financial debacle. In March 2023, SVB's collapse unfolded rapidly. Key issues included asset-liability mismatches and poor interest rate risk management. Unrealized losses and fair value accounting played significant roles, alongside the psychology of a bank run. Leadership, regulators, and venture capitalists all faced scrutiny for their roles in this financial debacle. SVB managed $173 billion in deposits, holding a 50% market share of United States venture-backed startups. The bank's collapse unfolded in just 36 hours, with a staggering $42 billion withdrawn in a single day. This rapid failure marks the largest bank collapse since 2008, highlighting vulnerabilities in modern banking systems. On February 28, 2023, Moody's warned about SVB's credit rating. By March 8, SVB sold $21 billion in securities, incurring a $2 billion loss. The next day, depositors withdrew $42 billion, leading to SVB's placement in Federal Deposit Insurance Corporation receivership on March 10. This rapid sequence underscores the speed of modern bank failures, fueled by digital banking and social media. SVB's downfall stemmed from a critical asset-liability mismatch. They held long-duration securities, yielding around 1.5%, vulnerable to interest rate hikes, while relying on short-term deposits from a concentrated tech customer base. This mismatch meant rising rates eroded their bond portfolio's value, creating a precarious financial position. Unrealized losses, like SVB's $15 billion, impact market perception despite accounting designations. When SVB sold $21 billion in securities, unrealized losses became realized, intensifying market panic. Hold to maturity and available for sale classifications influence accounting, but rising interest rates affect bond values regardless, highlighting the economic reality. Fair value measurement categorizes assets into three levels. Level 1 assets have active market quotes and are highly liquid. Level 2 assets rely on observable inputs and are moderately liquid. Level 3 assets involve unobservable inputs and are illiquid. Under Accounting Standards Codification 8-20, Silicon Valley Bank's holdings were mainly Level 1 and 2, yet market value disclosure raised concerns. Liquidity risk management is crucial for banks. Daily liquidity needs require cash reserves for normal operations, while stress scenario planning prepares for adverse conditions. Emergency funding lines ensure access to capital during crises. Silicon Valley Bank's failure to maintain adequate liquidity buffers, coupled with a concentrated depositor base, led to rapid depletion of liquid assets when confidence wavered. Bank-run psychology reveals how information cascades led decisions, as individuals follow others rather than fundamentals. The first-mover advantage incentivizes early withdrawals during uncertainty. Network effects among connected depositors amplify panic, while digital acceleration allows instant mass withdrawals. Silicon Valley Bank's collapse highlighted these dynamics, with venture capitalist group chats spreading panic rapidly. Silicon Valley Bank's leadership failed to hedge interest rate risks and communicated poorly during the crisis. Regulators overlooked the asset-liability mismatch, intervening too late. Rating agencies issued warnings, but their timing fueled panic. Venture capitalists, while rational, accelerated the collapse through coordinated withdrawals. The Silicon Valley Bank collapse highlights shared accountability across these stakeholders. SVB's communication failures intensified the crisis. The abrupt $2 billion loss announcement lacked context, fueling uncertainty. Delayed engagement with key depositors and an inadequate crisis response left stakeholders in the dark. The leadership's uncoordinated messaging failed to calm the market, exacerbating the panic and accelerating withdrawals. The Silicon Valley Bank collapse has prompted regulatory shifts, emphasizing tailored supervision for mid-sized banks with concentrated deposits. Liquidity standards may expand to smaller institutions, while stress testing will intensify, focusing on interest rate risks. Discussions are underway to potentially expand Federal Deposit Insurance Corporation coverage for business accounts, addressing concentration risks and enhancing financial stability. Asset liability management is crucial. Duration matching ensures stability. Diversification is key, as concentrated deposits pose risks. Effective crisis communication with stakeholders is vital during uncertainty. The speed of modern crises, amplified by digital banking, accelerates failure timelines. Silicon Valley Bank's collapse highlights these lessons, stemming from risk management failures, not fraud or toxic assets. Analyze both quantitative risk factors, such as interest rate fluctuations and liquidity ratios, and qualitative elements like stakeholder communication strategies. Evaluate counterfactual scenarios to understand potential outcomes and improve decision-making. This comprehensive approach ensures robust risk management and strategic foresight in financial operations. Thank you, and for further insights into real-world business scenarios, reach out via mobile at +91 87553 00795 or email support@skilledmba.com. Explore our resources at skilledmba.com to enhance your skills for modern business challenges. Learn, apply, and lead effectively in today's dynamic environment.